ultimately all crises have essentially the same roots, the same root causes. There are different contexts, different situations, different locations, different markets, but at the base of it is a sort of unanticipated or in fact unrecognized build-up of risk somewhere in the system, and the inability of regulators, of policymakers, even if they recognize that risk, to do very much about it till it becomes an explosive situation. And that is a relatively straightforward framework that we should look at the 2008 crisis as well. So the learnings that have come from it and the actions that have been taken clearly do go some distance in addressing the kind of risk factors that that crisis precipitated from. But if you look ahead and go back to the 800 years and project another 800 years if you want, it's very clear that crises will not end. There will be a crisis at some point. It is going to be a very profitable occupation if you can predict it and sell short or exit the market when the crisis is about to happen. But even if you don't, I think the safe prediction is that there will be recurrent crises. Every policy response is a solution to the past crisis, the last crisis, not the future one, and we will see a different set of factors driving this. But in the meanwhile, I think it's important to understand the intellectual foundations of the solutions that emerged from 2008, and I will talk briefly about two categories. The first is on monetary policy and the learnings that the monetary policy paradigm took from the crisis, and some change in direction that has materialized from that learning. You may sort of be now, when you read newspapers and so on, be exposed quite often to the concept of inflation targeting. This is a framework that the Reserve Bank of India has recently adopted, and it basically puts a formal commitment on the bank, on the central bank, to manage inflation. Now, there are of course degrees of difference in this approach. There is an extreme kind of a form of targeting, which is that the bank commits to a particular number and is heavily penalized for deviating to that number. For example, the Reserve Bank of New Zealand has a clause in its inflation targeting agreement that the governor will be fired or resign if the target is not met for a certain period of time. We haven't gone to that extreme, but in the more sort of realistic or practical space, there is a lot of pressure of embarrassment, of reputation on the central bank to meet the target, or if it doesn't, to provide very persuasive explanations for why it's not meeting the target. We are in that mode, and this mirrors some of the other countries that have followed the system. But what happened during the crisis was that the perception that the central bank should be exclusively focused on inflation, which was the dominant paradigm at that point. Of course, some countries challenged it. The US certainly challenged it. But the US also, the US Federal Reserve mandate, Professor Bhattacharya referred to Alan Greenspan's explanations, was focused on managing inflation and unemployment, the balance between the two. But very few central banks actually looked at the larger developments in the financial sector and the impact that whatever monetary policy paradigm you're following, whether it's inflation targeting or dual mandate as the Fed's approach is called, the financial sector became somewhat, or was always somewhat in the background. It was assumed to be functioning on its own. Yes, it was linked to the monetary system. If the central bank did something, it had consequences in the financial sector. But that was playing out in its own little box, and central bankers shouldn't be too worried about it. I think what the crisis demonstrated was that this is absolutely not the case. That actions by the central bank both contributed to and encouraged the the build-up of risks, which ultimately became the precipitating factor for the crisis. And the main reason for that, and that's one reason why Professor Greenspan is such a central figure, he was a